Some of his companies have climbed more than 1,000% since 2020.
Has officially passed Jeff Bezos to become the world's second richest person.
You know, I never thought I would say this, but I feel bad for Sam Bankman-Fried. He works his entire professional career to create the biggest fraud in corporate history, only to be one-upped just 2 months after he was arrested. The $8 billion in customer funds that were lost due to the crash in the fraudulent crypto exchange now pale in comparison to the $92 billion that has been wiped off the Adani Group's collective market cap since its alleged fraudulent activity was uncovered late last month by Hindenburg Research. Hindenburg Research is an investment research firm that specializes in short selling using a very simple 4-step process. Step 1. Find a company with something going wrong that isn't yet public knowledge, like a serious fault in their growth model, a significant market threat, or just plain old systematic fraud, as is the case with this Adani situation.
Hence, to insulate the investors from potential losses, we have withdrawn the FPO. This decision will not have any impact on our existing operations as well as our future plans.
Step 2. Short the company's stock. Step 3. Make a public announcement in the form of a research paper accompanied by a big marketing campaign to expose the problems with the company so that other investors also short sell the business, which will push the price down.
And this really goes straight to the heart of the empire of one of the richest people in the world, and it's having an effect across his different companies.
Step 4. Exit the short positions at a new low price with a healthy profit. It is a simple process that has made the appropriately named Hindenburg Research and other investment firms using a similar strategy lots of money by exposing corporate frauds. The great thing about this strategy for the short-selling research firm is that even if the underlying problems with the company turn out to be not true, just the market panic caused by a widely circulated accusation of corporate frauds can be enough to push the stock price down for long enough to allow the firm to cash out their short position for a profit. If the allegations do end up being overblown, then the short sellers that followed the lead of the initial short-selling research firm can end up being burned as the stock rallies back to its original price. Bill Ackman, the manager of the hedge fund Pershing Square Capital, put a lot of investors in this position with his failed short play on the multi-level marketing company Herbalife.
Round 1. Fight!
Ackman accused the company of being a fraudulent pyramid scheme after taking on a major short position combined with a marketing campaign that even included a documentary, Betting on Zero.
The strategy they came up with is what they call the bottom of the pyramid strategy. And it was a strategy where they decided to target the poorest people in the world. I mean, it sounds incredible, but it's actually true.
The short failed to play out as regulators didn't file any charges against the company, and it continues to operate to this day with the stock price even higher than it was before Ackman's short sale. The failed short play hurt Ackman's reputation, meaning other short sellers will be less likely to follow him into similar positions in the future, making it harder for him to profit off this 4-step plan in the future. However, he did say that Hindenburg's Adani report was highly credible, but given his track record, that might not be the endorsement they were looking for. A good reputation for digging up credible problems are very important for making this investment play work. So how is Hindenburg's track record? Hindenburg's last big short play was against Nikola Motors and their CEO Trevor Milton. After the report was released to the investing public, Nikola's stock price fell 40%, and an investigation by the SEC was opened into Milton, which eventually resulted in a conviction for wire and securities fraud. Since the paper was published in September of 2020, Nikola's stock is down over 90%. So when the same investment firm made similar accusations against one of the largest conglomerates in India, it understandably drew some attention. The 7 publicly listed companies in the Adani Group are now down over 50% from the record high prices they were trading at before Hindenburg's report was made public. Investors are now taking sides, because there is a lot of money to be made or lost no matter what happens from now on. If it turns out that the short thesis presented by Hindenburg Research is true, then the stocks could fall even further, making a lot of money for the short sellers following Hindenburg's lead. If the report turns out to be baseless FUD coming from an investment firm with a financial conflict of interest against the Adani Group, or if Indian authorities do not prosecute the Adani Group for the alleged crimes, then the stocks could rally back to their previous trading highs, leaving short sellers with a potential 100% loss on their positions. For everybody else on the sidelines, it is going to be fun to watch. So it's time to learn how money works to find out how the Adani fraud actually worked to create so much excess value in the stock price. This week's lesson was sponsored by BetterHelp. Mental health is something that is hard to talk about, but it's something that's incredibly important to me. Before YouTube, I worked at an investment bank where the expectation was that you should always be available, always deliver perfect results, and always put your work first. Nothing was more important than your job, which never felt right and would constantly make me anxious and sometimes even depressed. Talking to a therapist was the only thing that helped me, and I am grateful every day that I took that step. BetterHelp makes it even easier these days to get in touch with a therapist from the privacy of your own home with a 100% online service. The process is as simple as filling in a confidential online questionnaire, then BetterHelp can match you with one of their over 25,000 licensed and experienced therapists who can help you with a wide range of issues. And you can talk to your therapist however you feel comfortable. Whether it's text, chat, phone call, or video call, you can message your therapist at any time and schedule live sessions whenever convenient. And if the therapist isn't the right fit for you, you can change at no additional cost. With BetterHelp, you get the same professionalism and quality you expect from in-office therapy, but with a therapist who is custom-picked for you, more scheduling flexibility, and a more affordable price. If you have ever even considered that you could benefit from therapy, let me tell you that it will be probably one of the best things you could ever do. So join more than 2 million people who have taken charge of their mental health and get 10% off your first month at betterhelp.com/howmanyworks, which is linked in the video description. The Hindenburg research report had to prove two things to the investing community. Number one is that it had to prove that Adani's corporate leadership acted in a dishonest or fraudulent manner. And number two, it had to prove that this dishonest behavior resulted in the conglomerate's 7 different public companies being overvalued. The report is extremely long and quite technical, so I, along with a few of my friends like Richard from the Plain Bagel, have gone ahead and read it so you don't have to. The report makes 6 main arguments as to why it believes that the companies in the Adani Group are overvalued and are overdue for a significant correction. These 6 points, when taken together, also reveal how the fraud works to enrich the Adani family members at the center of this alleged scheme. The first accusation is that 7 of the companies in the group are simply overvalued by as much as 85% based purely off fundamental financial analysis when compared to other companies in similar industries. This part of the report is pretty weak sauce, because companies can have different valuations based off fundamental factors for a lot of different reasons. Hindenburg didn't mention growth statistics, the company's track record, or market dominance. Also, a company can have a high price-to-earnings ratio if they only made a penny in profit. All of the Adani companies are listed in the National Stock Exchange of India, which will have different industry standards than here in the States. In my own humble opinion, this probably shouldn't have been included in the report, because it was already well known by anybody invested in these companies. So far it's Adani 1, Hindenburg 0. Hindenburg's second point is that the company has too much debt. Certain Adani companies, especially their newer ventures like Adani Green Energy, have taken on a lot of leverage to scale rapidly by making big acquisitions of technologies, patents, machinery, and entire companies in the green energy space. If this plays out well, it will be seen as a genius business move, but it is incredibly risky. If the company can't produce cash flows to maintain its payments on this debt, then the whole house of cards could come crashing down very quickly. Hindenburg also raised another problem with the company's debt. Point 2b, if you will. The company themselves had a lot of debt, putting them in a potentially vulnerable position. But insiders in the company, for example the Adani family themselves and close associates, also had a lot of personal debt that they secured against their stocks in the Adani business. Some of the Adani companies like Adani Power are 75% owned by immediate relatives of the company's CEO, Gautam Adani. Despite the company's name, the Adani Group is not a family business, and having that much ownership concentrated in the hands of the founders should raise some alarms by itself. For sake of comparison, Jeff Bezos only owns 10% of Amazon, Elon Musk only owns 13.5% of Tesla, and Zuckerberg only owns 13.6% of Sol. Oh, and also Meta. The reason the Adani companies have had to rely so heavily on debt financing is because they haven't sold many of their shares to outside investors, which is the other way that companies raise money to fund expansion. Even if the highly concentrated ownership could be explained away by a PR firm claiming that the family just really believed in the companies, it doesn't get rid of the risk of individual margin calls. Of the 75% of Adani Power shares owned by the family, 25% of them have been pledged as collateral for loans taken out to benefit the lifestyle of individual members to pay for their extravagant lifestyle. The terms of these loans will have a rule that if the pledged shares fall below a certain value, the family members must contribute additional capital to make sure that the loan is always secure. If they cannot supply additional capital, the shares will be taken from them and sold to close out the position. Selling shares will lower the prices in public markets, which could trigger additional margin calls. 25% pledged of 75% family ownership in the company means more than 18% of Adani Energy shares could be forced onto the market if the price fell far enough. Currently, every single other investor in Adani Energy outside of the family only owns 25% of the company combined. So this would almost double the total outstanding shares in circulation in a very short amount of time, which would tank the price. Highly levered businesses will be struggling no matter what in the current interest rate environment. And in addition to the excessive borrowing of the family members backed by company stock, this is really the smoking gun that investors look for in short-selling research reports. So it's Adani 1, Hindenburg 1. The assumption in point 2A and 2B was that the Adani family and their associates were also being fully transparent about their share ownership and debt facilities.
Exactly. You go after real criminals, which makes me wonder what the hell you're investigating me for.
Hindenburg's third point was that the Adani family and their associates were not being fully transparent about their share ownership and debt facilities. Indian regulators require that any public company have a minimum public shareholding of 25%. This is why the Adani family only owns 75% of Adani Power. They can't legally own any more. These minimum public ownership rules are designed to avoid market manipulation and provide a minimum level of liquidity. The YouTuber Max Fosh made a video where he created a company with 10 billion shares and then convinced a random stranger to buy one of those shares for £50. This gave the company a technical market capitalization of £500 billion, and since he owned the other 99.99999% of shares in the company, he temporarily became the world's richest person.
I haven't done anything wrong, I'm just making silly videos. But I was very rich.
That was a fun video, but financial regulators obviously don't want markets to work like this, so they have rules like the 25% minimum public shareholding. The Hindenburg report accuses the Adani family and associates of circumventing this rule by setting up holding companies in offshore destinations, like Mauritius and the Cayman Islands, to conceal ownership behind these jurisdictions' corporate privacy laws. It's difficult to prove who really owns these companies without a leak like the Paradise or Panama Papers, but as much as 10% of the additional outstanding shares in certain Adani companies are owned by these suspect offshore entities. This could mean that the Adani family owns as much as 85% of the shares in certain Adani Group companies, which would not only violate the minimum public shareholding requirement laws, but also give them the ability to make financial plays like insider trading. Point number 4 made by Hindenburg is that a lot of the most senior positions in various Adani companies are held by Adani family members who are seriously underqualified to have received their position based off merit alone. Apart from Gautam Adani himself, the executive leadership of the company is filled with family members with little to no formal education or industry experience. In a family-run business, this is not a problem. But remember, despite the name, the Adani companies are a public business that anybody can invest in, and there is a fiduciary duty for the company leadership to do what is best by those shareholders. Employing underqualified family members is not in the shareholders' best interest. Normally, if a family member of a CEO applies for a senior role in a public company, permission would need to be granted by an ethics board, the board of directors, or even a shareholder vote depending on the company's corporate constitution. In the case of the Adani family, this wouldn't matter, because they own so much they can just give themselves permission if they even bothered to ask at all, which public records indicate they did not. In addition to having one of India's largest conglomerates being run by nepotism babies, the allegations made by Hindenburg is that the Adani family members in various senior positions scattered throughout the 7 companies could make trades using the offshore companies from point 3 based off of the information they would have access to from their jobs in point 4. These offshore entities might also have more loans secured against them, making the margin call risk from point 2B even worse. A lot of this depends on proving that the offshore holding companies that own additional Adani stock actually do belong to the family members, which is very hard to do. But what Hindenburg did point out was that the offshore entities were surprisingly good at making trades before the big company announcements. Hindenburg also spent a lot of time in the report connecting various dots that show that it's pretty unlikely that these offshore companies could be controlled by anybody other than the family members. Even if these offshore companies are not owned by the family at all, it's a serious problem for public investors that so few shares in the company are owned outside of the family in some shadowy offshore network. So it's Adani 1, Hindenburg 2. Hindenburg's 5th point was that the Adani family members that got given senior positions in the companies don't have the best track record when it comes to fraud. Gautam Adani's brother, Vinod and Rajesh, in addition to his brother-in-law Samir Vora, have all been implicated in several corporate tax frauds spanning decades. The family started out with a $181 million diamond trading fraud, and Rajesh has been arrested twice on separate counts of customs tax avoidance and forging import documents. Character assassinations like this is common for investment firms taking a major short position against a company, so take everything you hear from Hindenburg with a pinch of salt, because they are not going to highlight the past successes of these men. They are only going to highlight the flaws, although in this case, those flaws are pretty big. Prior involvement in serious and well-documented cases of investor fraud raise even more questions about how these brothers got their executive roles over other applicants with more experience and less criminal records. Hindenburg takes the win again here, so it's Adani 1, Hindenburg 3. Point 6 is how points 1 through 5 work together to build a sophisticated scheme to enrich the Adani family at the expense of lenders and outside investors. The Adani family owns a large share of the companies which they can inflate in value by insider trading with their offshore entities to fake trading activity and capitalize on material inside information. Once the stock price has been pumped up, the family took out loans by using their overinflated shares as collateral. They used the money from these loans to set up more offshore entities, to which caused the value of the Adani Group companies to grow over $200 billion, temporarily making Gautam Adani, the ringleader of this alleged fraud, the third richest man in the world. The very fact that the Adani family owns so much of the various companies will make it very difficult for Hindenburg to unwind their short position, so their endgame is one of 3 possible outcomes. Option 1 is that enough other short sellers enter the market that they exit their position without pushing the price back up. Option 2 is that the stocks fall far enough that the Adani family members get margin called and are forced to liquidate their positions, giving Hindenburg the liquidity they need to make an exit. And option 3 is that the scathing report builds up enough public outrage that regulators are forced to intervene and either delist the company entirely or force the Adani family members to liquidate their holdings above the 75% maximum insider shareholding limits. It's possible that this doesn't happen, because a rags to riches story like the Adani Group is almost a source of national pride in India, so authorities might decide to simply look the other way. Nobody knows exactly how this will play out, which is why there is so much activity on either side of the short position. I would advise caution speculating on the outcome of this short play, because everything that either side is saying is backed by large financial interest in the share price going one way or the other. Unsophisticated investors might also rally behind a strong figure like Gautam Adani, who has built a personal reputation as a genius businessman, a trait that all other investors should be very careful of. You can find out why by watching my video on the big problem with really smart people. A special thanks again to BetterHelp for making it possible for everybody to keep on learning how money works.
Oh crap, this is bad. This is bad. After all I said, they'll probably call this a hate crime.